Today, we're diving into the age-old question: S&P 500 versus other market indices. Which should you invest in? The S&P 500, comprising 500 of the largest publicly traded companies in the United States, is often considered a benchmark for the overall stock market performance due to its broad representation of various sectors and industries. As a market-weighted index, it reflects the collective performance of these leading companies, providing investors with valuable insights into the health and direction of the U.S. economy. Additionally, the S&P 500's long history and extensive data make it a reliable gauge for measuring investment returns and evaluating portfolio performance over time. Its inclusion criteria, stringent enough to maintain quality and relevance, ensure that the index remains a trusted indicator for investors worldwide. While the S&P 500 is widely followed, other market indices offer unique insights into different sectors and market segments. For instance, the Dow Jones Industrial Average focuses on 30 large blue-chip companies, providing a snapshot of industrial and economic trends. These companies are leaders in their respective sectors, representing a diverse range of industries, including technology, finance, healthcare, and consumer goods. Due to its concentrated nature, the Dow offers a straightforward perspective on the performance of these key players, making it particularly useful for investors seeking insights into established industry-leading companies. Additionally, because of its historical significance, dating back to the late 19th century, the Dow Jones Industrial Average is often regarded as a barometer of broader economic conditions, influencing investor sentiment and market sentiment alike. Each index has its advantages and drawbacks, depending on your investment goals and risk tolerance. Understanding these nuances is crucial for constructing a well-balanced and diversified portfolio. For instance, while the S&P 500 offers broad exposure to the U.S. market and is widely regarded as a reliable benchmark, its heavy weighting towards large-cap stocks may lead to less exposure to smaller companies with high growth potential. On the other hand, indices like the NASDAQ Composite, with its focus on technology and innovation, may offer greater opportunities for capital appreciation, but also come with increased volatility. Similarly, the Dow Jones Industrial Average's concentration on 30 blue-chip companies provides stability and insight into established industry leaders, but it may lack representation from emerging sectors. Meanwhile, indices such as the Russell 2000, which tracks small-cap stocks, can offer exposure to companies with significant growth prospects, but may also carry higher risk due to their smaller size and potentially limited liquidity. Ultimately, choosing the right index or combination of indices requires careful consideration of your investment objectives, time horizon, and risk tolerance. By understanding the strengths and weaknesses of each index, investors can tailor their portfolios to align with their financial goals while managing risk effectively. So, which should you invest in? The answer depends on your financial objectives, time horizon, and risk appetite. Consider diversifying your portfolio across multiple indices for a well-rounded approach to investing. Remember, always do your research and consult with professionals before making any investment decisions.